stop right there. If you're a pensioner in the UK or about to become one, I need 60 seconds of your time, because what I'm about to share could genuinely put hundreds of pounds back in your pocket this year. Most pensioners are paying more tax than they actually need to, simply because nobody explained the rules properly. I'm going to fix that today, in plain English, no jargon, no confusion. Stay with me. Welcome to Smart Pension UK. I'm here to make your retirement finances crystal clear, and today we're tackling something that causes more confusion than it should: pensioner tax. Now, I know the word tax makes everyone's eyes glaze over, but trust me, understanding these basics could save you serious money. So grab a cup of tea, get comfortable, and let's sort this out together. First things first, let's clear up the biggest myth. Many people think that once you retire, you stop paying tax. Unfortunately, that's not true. Your pension income is taxable, just like your salary was when you were working. The good news? You still get a personal allowance, which means the first chunk of your income is completely tax-free. For the 2025 to 2026 tax year, your personal allowance is £12,570. This means if your total income from all sources, including state pension, private pensions, and any other income, is below this amount, you won't pay a penny in tax. Let me say that again because it's important. £12,570 tax-free. Now here's where it gets interesting. Your state pension counts toward this allowance. The full new state pension for 2025 to 2026 is around £11,502 per year. That's already eating up most of your personal allowance before you've even touched your private pension or any other income. This catches a lot of people off guard. Let's talk about how you actually get taxed. Once you go over that £12,570 threshold, you start paying income tax. In England, Wales, and Northern Ireland, the basic rate is 20% on income between £12,571 and £50,270. The higher rate is 40% on income between £50,271 and £125,140. And if you're fortunate enough to earn more than that, the additional rate is 45%. Scotland has slightly different rates and bands, so if you're living north of the border, make sure you check the Scottish income tax rates specifically. They have more bands and slightly different percentages. Now let me share something that could save you money right away. Your tax code. This little combination of numbers and letters on your pay slip or pension statement tells your pension provider how much tax to deduct. The standard code for most pensioners in 2025 to 2026 is 1257L. That 1257 represents your personal allowance of £12,570. But here's the problem. If you have multiple pensions, sometimes your tax code gets messed up. You might have an emergency tax code, or your personal allowance might be split incorrectly between different pension providers. I've seen pensioners overpaying thousands of pounds simply because their tax code was wrong. Check your tax code on every pension statement you receive. If it doesn't look right, contact HMRC immediately. Let's talk about something called the marriage allowance, because this is free money that thousands of pensioners are missing out on. If you're married or in a civil partnership and one of you earns less than the personal allowance while the other is a basic rate taxpayer, you can transfer 10% of your personal allowance to your partner. That's £1,260 transferred, which could save you up to £252 in tax every year. You can even backdate this claim for up to 4 years. That could be over £1,000 just sitting there waiting for you. Here's another big one that trips people up: taking money from your pension pot. If you have a defined contribution pension, you can usually take 25% of it as a tax-free lump sum. This is a brilliant option, and you don't pay a penny of tax on that 25%. However, the remaining 75% is taxable as income when you withdraw it. The key is to be strategic. If you take out a massive chunk in one go, you could push yourself into a higher tax bracket just for that year and lose a huge amount to tax. Instead, consider spreading your withdrawals over several years, keeping yourself in the basic rate tax band if possible. A little bit of planning here can save you thousands. And if you're not sure how to do this, speak to a financial advisor. This is exactly the kind of situation where professional advice pays for itself many times over. Now, let's talk about something called the personal savings allowance, because this affects how much interest you can earn on your savings without paying tax. Basic rate taxpayers can earn up to £1,000 in interest tax free each year. Higher rate taxpayers get £500. Additional rate taxpayers get nothing, unfortunately. But here's the catch: if your total income, including that interest, pushes you into a higher tax bracket, you lose some of that allowance. It's all connected. Gift aid is another area where pensioners can benefit. If you donate to charity and you're a taxpayer, you can use gift aid. The charity claims back the basic rate tax on your donation, making it worth more to them at no extra cost to you. But if you're a higher rate taxpayer, you can claim back the difference between the higher rate and basic rate on your tax return. It's a win-win situation. Let me address something that causes real stress: tax returns. Most pensioners don't need to fill in a self-assessment tax return. If all your income comes from your state pension and one or two private pensions, and the tax is deducted correctly through pay, you're probably fine. However, you might need to file a return if you have rental income, significant savings interest, income from overseas, or if you're self-employed. If you're unsure, check with HMRC. It's always better to ask than to miss a deadline and face penalties. Here's a really important point about timing. If you're approaching retirement and you have some control over when you take your pension or lump sums, think carefully about the tax year. Taking everything in one tax year could be costly. Sometimes waiting a few months and splitting income across 2 tax years can save you a substantial amount. Again, this is where a quick conversation with a financial advisor or even HMRC can be invaluable. Let me tell you about something called the High Income Child Benefit Charge, because it catches some grandparents out. If you're still claiming child benefit for a child under 20 and your income goes over £60,000, you start paying this charge. It tapers up until you're paying back all the child benefit once you earn over £80,000. If you've taken a large pension withdrawal and pushed your income over this threshold, you could get an unexpected tax bill. Council tax is another area to mention. While it's not technically income tax, many pensioners are entitled to council tax reduction or support. If your income is low, you could get a significant discount on your council tax bill. Every local council runs their own scheme, so check with your local authority. Some pensioners are entitled to up to 100% reduction and don't even know it. One of the most powerful tools you have is communication with HMRC. If you think you've overpaid tax, you can claim it back. If you've underpaid, it's better to sort it out sooner rather than later, when penalties and interest start adding up. HMRC has a dedicated helpline for older people, and honestly, I've found them quite helpful when you get through to them. Don't be afraid to call and ask questions. It's your money we're talking about. Let me share a real-world example. Imagine you're getting the full state pension of £11,502, and you have a small private pension paying you £3,000 a year. Your total income is £14,502. After your personal allowance of £12,570, you're left with £1,932 of taxable income. At 20%, that's £386.40 in tax for the year. But if your tax code is wrong and they're not giving you your full personal allowance, you could be paying tax on the full £14,502, which would be nearly £300 more. That's real money that should be in your pocket. Finally, let's talk about planning ahead. Tax rules change almost every year. Allowances go up, sometimes bans change, and new rules come in. Stay informed. Watch channels like this one, read the government websites, and if your situation is complex, consider getting professional advice. The money you spend on a good accountant or financial advisor can save you multiples of their fee in reduced tax. Remember, paying tax isn't something to be ashamed of. It means you have income, which is a good thing. But paying more tax than you legally need to? That's just giving away your hard-earned money. You've worked your whole life, you've paid your taxes, and now in retirement, you deserve to keep every penny you're entitled to. So there you have it. Pensioner tax doesn't have to be complicated. Check your tax code, claim what you're entitled to like marriage allowance, be strategic with pension withdrawals, and don't be afraid to contact HMRC when you need help. These simple steps could genuinely save you hundreds of pounds every single year. If you found this helpful, please give this video a thumbs up and subscribe to Smart Pension UK. We're here every week with clear, practical advice to help you make the most of your retirement. Drop a comment below and let me know what pension topic you'd like me to cover next. And if you know another pensioner who could benefit from this information, share this video with them. Knowledge is power, especially when it comes to your finances. Until next time, take care, stay informed, and enjoy your retirement. You've earned it.